Right now, as you watch this video, something is happening to your money. And nobody told you about it. Over the last 3 years, the average American has lost $23,000. Not from their bank account. Not from a scam. From something far more hidden. Something the people at the top don't want you to understand. Because if you knew the truth, everything would change. Here's what they've been hiding. First, your dollar isn't worth what you think it is. There's a silent tax eating your paycheck every single day. Second, the numbers you see on the news? They're not the real numbers. There's a separate set of data that only insiders have access to. And third, the biggest revelation of all. The system was designed this way. On purpose. But the truth behind this will shock you. You see, while everyone was arguing about politics and watching the stock market, the largest wealth transfer in American history happened right under our noses. Trillions of dollars moved from one group to another. And most people didn't even notice it happening. I spent 3 months digging into government reports, interviewing economists, and following the money trail. What I found will change how you see every dollar you earn. Let's go back to March 2020. The world shut down. Businesses closed. Millions lost their jobs overnight. The government had to do something fast. So they did something they'd never done before. Not at this scale. They printed money. Lots of it. In just 18 months, the Federal Reserve created more dollars than existed in the entire first 200 years of America. Think about that. More money in a year and a half than in 2 centuries. The number is staggering. $4.8 trillion. Created from nothing. But here's the first surprise. Most of that money didn't go where you think. You probably got a stimulus check. Maybe $1,200. Maybe $2,000. That felt like a lot at the time, right? But that was only $300 billion total. Out of $4.8 trillion. So where did the rest go? This is where things get interesting. The Federal Reserve has a tool called the discount window. It sounds boring. But it's actually one of the most powerful financial weapons in the world. Banks can borrow money from this window at incredibly low rates. Almost 0% interest. And during the pandemic, they borrowed trillions. But they didn't use it to give you better loan rates. They didn't use it to help small businesses stay open. Second surprise. They bought assets. Stocks. Bonds. Real estate. Things that were suddenly very cheap because everyone was panicking. And this created a problem. Actually, it created the problem. See, when you create trillions of new dollars, something has to give. It's basic math. If more dollars are chasing the same amount of stuff, each dollar becomes worth less. This is inflation. But not the kind you learned about in school. The government measures inflation with something called the Consumer Price Index. The CPI. It tracks prices of everyday things. Bread. Milk. Gas. Rent. In 2021, the government said inflation was 4%. Not great, but manageable. Third surprise. The real number was much higher. There are other ways to measure inflation. One is called shadow stats. It uses the old formula from 1980, before the government changed how they calculate things. According to shadow stats, real inflation in 2021 was over 12%. 3 times higher than official numbers. Why does this matter? Because your raise was probably based on that 4% number. Your savings account interest? Based on 4%. Your retirement calculations? 4%. But your actual costs went up 12%. That gap. That's where your $23,000 went. Now here's where things get really interesting. Let me show you something most people never see. There's a chart. It's called M2 money supply. Sounds complicated, but it's simple. It shows how many dollars exist in the economy. From 1980 to 2019, this chart looked like a steady hill, climbing slowly, predictably, about a 6% growth every year. Then March 2020 hit. The line goes vertical, straight up, like a rocket. In 1 year, the money supply increased by 26%. That's 4 times the normal rate. In 1 year. But here is what nobody talks about. That new money didn't spread evenly. Imagine you're in a room with 10 people. Someone drops $1 million from the ceiling. But it falls on one side of the room. The people on that side grab the money first. They can spend it before prices go up. They buy assets before they get expensive. The people on the other side? By the time the money reaches them, everything costs more. They're playing catch-up. This is called the Cantillon effect, named after an economist from the 1700s who first noticed it. The people closest to new money benefit most. The people furthest away get hurt. So who was closest to the money in 2020? Banks, hedge funds, large corporations, people who could borrow millions at 0% interest. They bought everything: houses, stocks, land, commodities. Look at home prices. In 2020, the median home cost was $280,000. By 2022, it hit $420,000. That's a 50% increase in 2 years. Your salary didn't go up 50%, did it? This created a massive problem. Regular Americans got priced out of the housing market. First-time buyers couldn't compete. Families looking to upgrade were stuck. Meanwhile, institutional investors bought entire neighborhoods. Companies like BlackRock and Vanguard purchased thousands of homes, turned them into rentals. In some cities, investment firms bought 1 out of every 4 homes sold. This wasn't an accident. This was the system working exactly as designed. But it gets worse. The stock market did the same thing. In March 2020, the S&P 500 crashed. It dropped 34% in 1 month. Rich investors saw an opportunity. They borrowed cheap money and bought stocks at a discount. By the end of 2021, the S&P was up 90% from the bottom. 90% in less than 2 years. If you had $1 million to invest in March 2020, you'd have $1.9 million by 2021. You made $900,000 just by having money to start with. But if you were living paycheck to paycheck in 2020, you missed out completely. This is how wealth transfers work. Not through robbery. Through timing and access. The rich got richer not because they're smarter. Because they were closer to the money printer. And this brings up an obvious question. Why don't more people know about this? There's a reason this stays hidden. The way we talk about the economy is designed to confuse you. Let me prove it. You've heard the term quantitative easing. Politicians and economists use it all the time. It sounds technical, scientific, safe. But it's just a fancy way of saying printing money. They don't call it printing money because that sounds bad. It reminds people of Zimbabwe or Venezuela, countries that printed so much money that their currency became worthless. So they use different words. Quantitative easing, asset purchases, monetary expansion. Same thing. Different packaging. This is deliberate. The Federal Reserve has a whole department dedicated to communication strategy. Their job is to explain policy in ways that don't cause panic. But here's what they're not telling you. There's a difference between the 2 types of inflation: asset inflation and consumer inflation. Asset inflation is when stocks, houses, and investments get more expensive. This makes rich people richer on paper. The news calls this economic growth. Consumer inflation occurs when food, gas, and rent get more expensive. This makes regular people poorer. The news calls this concerning. From 2020 to 2022, we had both. Asset inflation was massive. Stock market up. Housing up. Everything investors own went up. Consumer inflation came later. It started small. Then it got bigger. By 2022, it was impossible to ignore. Gas hit $5 a gallon. Groceries cost 30% more. Rent went up 20% in some cities. Now here's the trick. The Federal Reserve only really cares about consumer inflation. That's what they try to control. Asset inflation? They actually want that. It's considered healthy for the economy. But think about what this means. If you own assets, inflation helps you. Your house is worth more. Your stocks are worth more. You're wealthier. If you don't own assets, inflation hurts you. Everything costs more. Your savings are worth less. You're poorer. The system rewards people who already have wealth. It punishes people who are trying to build it. This isn't a bug. It's a feature. Let me show you how deep this goes. In 2020, billionaire wealth increased by $1.9 trillion in 1 year, during a pandemic. Meanwhile, 40 million Americans filed for unemployment. Food bank lines stretched for miles. Evictions were only stopped by government orders. The wealth gap got bigger than it's been since the 1920s, right before the Great Depression. But you didn't hear much about this on the news, did you? That's because of what's called the wealth effect. When asset prices go up, it creates the illusion of prosperity. The stock market becomes a barometer for the whole economy. Politicians point to the stock market and say things are good. Look how high the Dow is. Look at the SP. But only 55% of Americans own any stock at all. And most of that is in retirement accounts they can't touch. The top 10% own 89% of all stocks. So when the market goes up, it mostly benefits people who are already wealthy. For everyone else, it just means everything's getting more expensive. There's another layer to this. The government changed how they measure inflation back in the 1990s. They made changes that consistently show lower numbers than the old method. One change is called substitution. If steak gets too expensive, the index assumes you'll buy chicken instead. So they count chicken prices, not steak. Another change is hedonics. If a new phone costs more but has better features, they adjust the price down. They say you're getting more value. These sound reasonable. But they have an effect. They make official inflation numbers lower than what people actually experience. This matters because Social Security, wages, and government benefits are tied to official inflation numbers. If official inflation is 4% but real inflation is 8%, you're losing 4% of your buying power every year. Over 10 years, that's 40%. This is the hidden tax I mentioned at the beginning. It's not a tax bill. It's the slow erosion of your dollar's value. And it's completely legal. Everything I just told you wasn't a mistake. It was the plan. In 2019, before anyone knew about COVID, there was a crisis. You probably didn't hear about it. It happened in something called the repo market. This is where banks lend money to each other overnight. In September 2019, interest rates in the repo market suddenly spiked. They went from 2% to 10% in one day. This was a huge red flag. It meant banks didn't trust each other. They were scared to lend. The Federal Reserve had to step in immediately. They pumped billions into the system to keep it stable. But here's the thing. This happened 6 months before COVID. The financial system was already cracking. Some economists believe the pandemic was actually a convenient time. It gave the government cover to do what they were already planning. They needed to flood the system with money. But they needed a reason the public would accept. COVID provided that reason. Now, I'm not saying the pandemic was planned. That's not what I'm saying. The virus was real. The deaths were real. But the response? The financial response was already on the table. Let me show you the evidence. In October 2019, the Federal Reserve held an event called Going Direct. It was attended by central bankers and major investors. The topic: how to get money directly into the economy during the next crisis. Not through banks. Directly to people and businesses. Sound familiar? That's exactly what happened in 2020. Stimulus checks. PPP loans. Direct payments. This was already planned before COVID hit. There's more. In early 2020, before lockdowns started, certain hedge funds made massive bets against the market. They shortened airlines, hotels, cruise lines. They made billions when these stocks crashed in March. How did they know? Some say it was just smart analysis. Reading the news from China. Seeing what was coming. Maybe. But the timing was suspiciously perfect? Here's what we know for certain. The people at the top had information faster than everyone else. They had models, projections, inside connections. While regular Americans were being told everything was fine, insiders were repositioning their money. By the time the public panicked, the smart money had already moved. This is always how it works. The 2008 financial crisis? Same thing. Insiders knew the housing market was a bubble. They bet against it while telling the public everything was stable. When it crashed, they made fortunes. Then they got bailed out with taxpayer money. The people who caused the crisis got bonuses. The people who lost their homes got nothing. And it's happening again. Right now, there are warning signs everywhere. The same patterns from 2008. The same patterns from 2020. Student loan debt is at $1.7 trillion. Credit card debt just hit $1 trillion. Auto loan defaults are rising. The housing market is cooling. Banks are tightening lending standards. The yield curve is inverted. These are all recession signals. But the news keeps saying everything is fine. The job market is strong. The economy is resilient. Maybe it is. Maybe I'm wrong. But here's what I know. Every major crisis in the last 20 years was preceded by officials saying everything was fine. In 2007, Ben Bernanke said subprime mortgages were contained. A year later, the whole system collapsed. In early 2020, officials said COVID wasn't a threat. 2 months later, everything shut down. The pattern is clear. By the time they admit there's a problem, it's too late for regular people to protect themselves. The insiders have already moved their money. So what does all this mean for us today? Let's talk about what this means for you right now. First, understand that inflation isn't going away easily. The Federal Reserve raised interest rates to fight inflation. Rates went from near zero to over 5%. This was supposed to cool things down, make borrowing expensive, slow the economy. And it worked. Sort of. Inflation came down from 9% to 3%. Still higher than the 2% target. But better than it was. But here's the problem. Those higher interest rates created new issues. Mortgages are now 7%. Car loans are 8 to 10%. Credit cards are over 20%. This means buying a house costs twice as much as it did 3 years ago. Not because houses doubled in price. Because the interest payments doubled. A $300,000 house at 3% interest costs you $1,000 a month. The same house at 7% costs $2,000 a month. Same house, same price, double the cost. This is squeezing the middle class. Young people can't buy homes. Families can't upgrade. Everyone's stuck. Meanwhile, rich people who bought assets in 2020 are doing great. They locked in low interest rates. Their houses and stocks went up. They're insulated. The gap keeps growing. Second implication. Your savings are losing value. Even with higher interest rates, most savings accounts pay less than 1%. Some pay 3 to 4% if you shop around. But if real inflation is 5 to 6%, you're losing money every year. This forces people to take risks. Put money in stocks. In crypto. In real estate. But not everyone can afford risk. Not everyone has extra money to invest. So the people who need safe savings the most are the ones getting hurt. Third implication. Jobs look good on paper but feel bad in reality. Unemployment is low. Job openings are everywhere. Wages are going up. But when you adjust for inflation, wages are basically flat. You're making more dollars but buying the same amount of stuff. Plus, many new jobs are gig work. Contract positions. No benefits. No stability. The quality of jobs has gone down even as the quantity went up. Fourth implication. Debt is becoming impossible. Student loans. Medical bills. Credit cards. More Americans are drowning in debt than ever before. And with higher interest rates, that debt is getting more expensive to service. This creates a trap. You take on debt to afford rising costs. But the debt itself becomes unaffordable. Eventually, something breaks. Either you default or you cut spending dramatically. Either way, it hurts the economy. So what can you do about all this? Here's the truth. As an individual, you can't change the system. But you can protect yourself within it. First, understand that cash is not safe. Not long-term. Keep emergency savings, yes. But don't park your wealth in dollars. Second, own assets if possible. Even small investments. A little stock. A little real estate if you can. Things that go up when inflation goes up. Third, increase your skills. In uncertain times, the best investment is yourself. Learn things that make you more valuable. More adaptable. Fourth, reduce debt when possible. High interest debt, especially. Every dollar of debt is a dollar you're paying to stay in place. Fifth, stay informed. Don't trust one source. Don't believe everything you hear. Follow the money. Ask who benefits. This isn't about being paranoid. It's about being realistic. The system isn't designed to help you build wealth. It's designed to extract wealth from you. Understanding that is the first step to working around it. Before we wrap up, there's one final thing you need to know. Here's the last piece of the puzzle. Everything I've told you is documented. Public record. Anyone can find this information. But most people don't. Why? Because we're distracted. Intentionally. Think about what dominates the news. Political drama. Celebrity scandals. Cultural wars. These things are real. They matter to some degree. But while everyone argues about them, the money keeps moving. Policies keep changing. Wealth keeps concentrating. This is by design. As long as people fight about left versus right, they won't notice up versus down. As long as we're divided by politics, race, and gender, we won't unite around economics. The real divide isn't Democrat versus Republican. It's insiders versus outsiders. People with access to information and capital versus people without. And the craziest part? This isn't even hidden anymore. Billionaires openly brag about buying assets during crashes. Politicians openly trade stocks based on inside information. The Federal Reserve openly says it's trying to create the wealth effect. It's all out in the open. We just don't look at it as a connected system. We see individual events, separate news stories, unrelated policies. But when you connect the dots, the pattern is clear. Every crisis follows the same playbook. Print money. Bail out the big players. Let assets inflate. Let regular people struggle with the aftermath. Then wait for the next crisis. This has been happening for decades. It will keep happening until enough people understand the game. And that's why videos like this matter. Not because I have all the answers. I don't. Not because you should panic. You shouldn't. But awareness is the first step toward change. When enough people see the pattern becomes harder to maintain. When enough people ask questions, the questions become harder to ignore. This is why financial education is so important. Why understanding money matters. It's not just about getting rich. It's about not getting robbed. The system will keep working the same way until we demand something different. And demanding something different starts with knowing how things actually work. Let's recap the biggest revelations. 1. The government created $4.8 trillion in 18 months. Most of it went to banks and large investors, not regular people. 2. Real inflation was much higher than official numbers. This created a hidden tax that cost the average American $23,000. 3. Asset inflation helps the rich while consumer inflation hurts everyone else. The system is designed to reward people who already have wealth. 4. The 2020 financial response was planned before COVID hit. Insiders positioned themselves to profit while the public was caught off guard. These aren't conspiracy theories. These are documented facts that most people never connect. Understanding this changes everything. It changes how you see the news. How do you make financial decisions? How do you prepare for the future? And it raises an important question. What comes next? Honestly, nobody knows for sure. The economy is complex. There are too many variables. But history gives us clues. After every major money printing event, there are consequences. Sometimes inflation. Sometimes asset bubbles. Sometimes both. We're seeing some of that now. But it might not be over. The debt is still growing. The money supply is still elevated. The system is still fragile. Another crisis could happen tomorrow. Or 5 years from now. Or never. But being prepared isn't about predicting the future perfectly. It's about understanding the game well enough to adapt. That's what I'm trying to do with this channel. Break down complex topics. Connect the dots. Show you what's really happening behind the headlines. If you found this valuable, hit the subscribe button. More videos like this are coming. Leave a like if this changed how you see the economy. It helps more people find this information. And here's a specific question for you. What's the biggest way you've personally felt the impact of inflation in the last 3 years? Drop your answer in the comments. I read everyone. And your experiences help other viewers realize they're not alone in this. I'll see you in the next video.